Hey everyone, it is Evan here from the Trade Risk on Tuesday, March 31st, here with a midweek market recap video. We're going to cover all of the major markets and the current market environment. So today, last day of March, last day of the month, last day of the quarter, first quarter coming to an end today, and I believe this was the worst quarter for US stocks. I think I saw the headline getting thrown around there, so quite a historic period again that we are sort of trading through right now. And with that, let's jump into the markets. Let's look at how things are progressing. You can see we did finish out the last day of the quarter here on a negative note. Dow and S&P, Russell 2000, NASDAQ all falling 1% to 2% here on Tuesday. Notice though, we do still have strong, firmly positive 5-day change numbers here. We are still below, above the 10 SMA, which we reclaimed last week, but we are still below the 50 and 200 SMA right across the board. Now, if we scroll down and take a look at sectors here, you can still see a sea of green: utilities, healthcare, industrials rounding out the top three. On the downside, semiconductors falling to the bottom of the list, followed by transports and discretionary. And in terms of major markets, high yield, so credit markets now really rebounding aggressively here at the top of the list. Big move for HYG, followed by S&P and the emerging markets. And on the downside, oil, volatility, natural gas rounding out the bottom three for major markets. Now, if we jump into the charts here, and we take a look here at the S&P 500. This is a weekly time frame chart, so each bar represents 1 week worth of trading, and this is the cash settled S&P 500 market. So this is where we like to start our analysis, get the big picture view of what's going on here. And we can see on the week, we are up right now. Of course, it's only Tuesday, but we are up 2% here in the S&P 500. We're a bit off of the highs of the week, which were made yesterday on Monday, given today's action, but still we're seeing right now anyway, price continue to hold on to the majority of last week's bullish outside reversal, really a bullish engulfing weekly bar here, and we're continuing to hold on to those gains. So one of the big themes, and we spent a lot of time in our market recap video this past Friday, our last one, one of the things we talked about most is that to continue to remain optimistic on this market, or to transition to an optimistic stance in this market, given the developments that took place last week, we would want to continue to see ranges compress. We would want to continue to see hints of stabilization, and the way we measure, or at least the way I like to measure stabilization, is by seeing ranges compress. So basically, let's leave behind all of the limit down, well, I don't think we even had. Did we have a limit up future session? Maybe one we did, but I think basically everything was limit down. But let's leave those limit down overnight future sessions in the past, and let's start shrinking the day-to-day S&P 500 ranges from 5, 6, and 7% down to 2, 3, and 4%, and that would be the step in the right direction to continue to see this market stabilize and to continue to see healthy action and buying start to emerge here in the stock market. That's what we want to see, and so far I still think we're doing a pretty good job at that happening. Last week was, of course, the transition, the change of character happened last week, where we did get this outside reversal where we probed down to 2191 here in the market. Selling dried up. Enough was enough. The market reversed, closed up towards the highs of the week, and finished up 10%. That was the constructive week to take notice. It doesn't mean we're out of the woods by any stretch. But what it does mean is that we at least have a line in the sand and a change of character to sort of hang our hats on. So the way I would look at this going forward, where we stand right now, is that these horizontal lines on the chart, those are still the critical levels that I would be paying attention to on any potential retrace. So 2440, this is the upper level that I would be paying attention to if this market starts to roll over, to see how it would act around this general area. And if we go down to the daily chart here, you can see kind of the significance of this. This was sort of the top end of this, started to transition to that sideways range last week or 2 weeks ago. You could see the top end where sellers were coming in around 24.40 or so, the midpoint 23.46, and all the way down to 22.90, which would effectively close out the gap that we saw from last Tuesday on the 24th. These are, in my opinion, the critical areas for this market to hold above going forward. And, based on the coiling action that we're seeing right now, where we basically have, 3 days of really tight kind of price action here on a relative basis, pretty tight compared to recent levels. I think this is going to be an interesting breakout to watch, potentially as early as tomorrow, as we open up here and we start to see if these higher lows gets broken to the downside, or if we can actually break through this flat resistance here around 26, 28 in the market and start lifting up to higher prices and start retracing further in this downtrend that we've been in. So I think immediately tomorrow we'll start to get some clues here as to how the market ends up resolving this range. I do think that the longer we stay over 24.40 without coming back down and filling and testing, I do think that lends itself to short-term win for the bulls, in the fact that we could potentially see a second leg higher here if we continue to stay over this 24.40 level. The big question really seems to be, as always becomes the question when we see a big fall in the market or even a mild fall in the market, is will the lows get retested? Do we have to come back down and retest these lows? And we spent, I believe it was at the very start of March, we spent some time answering this question in a prior circumstance. I think it was right in here on whether or not the lows need to be retested, and we basically went back over the past 5 to 7, 8 years worth of pullbacks, and we looked to see V-shaped rallies versus retests and sideways consolidations, and basically it's a coin flip. Sometimes the market comes down and retests lows, and sometimes it doesn't. There's no hard and fast rule to it. That's often the case with markets. There's there's never really a sure thing or something that always has to happen. It always depends, and it always depends on the circumstances and how we got there, and how abruptly those catalysts go away or change. So we don't know if we're going to come back down here and retest the lows, but we of course again have ways to sort of measure and sort of take the price action on a day-to-day basis, so we can still make trade decisions and so we can still follow along in this market. And again, like we talked about at the top, I think the most constructive thing we can look for if you're bullish or if you want to be bullish on this market is to continue to see volatility, the VIX fall, ranges start to compress here, and we start to get more normal sort of two-way markets and just generally speaking, healthy environments where you can feel confident starting to step in, and to know that some of the bigger funds are starting to step in and put a floor in the market and bid this market. That's what, of course, we would look for as the hallmark sign for things continuing or progressing into the bullish fashion. But we know right now with a VIX that is still up at 53, which is historical nosebleed levels, we still need to be very careful here, and we know risk can happen fast when a VIX is still trading up at that area. So for the near future, I think we can look at this range here and see how this acts going into tomorrow and into the end of this week. I think that'll be your first tell. 24.40, 23.46, 22.90. Those are the areas I'm watching for on the sort of the downside. And the other situation here. So we talked about the V-shaped action that could happen. We talked about a retest of the lows that could happen. Another thing to keep an eye out for is just a higher low sort of scenario here, which to me would be almost one of the most bullish scenarios that could unfold, and it might actually be the scenario that both sides, both sellers and buyers, would have trouble navigating is, let's say that the market does spill over hard from here. Let's say we fall 3-4% and we do that 2 days in a row, and we come back down into this general area here, and then suddenly, the selling dries up, and the market starts to float higher, and it puts in a higher low here, and then it starts to ratchet higher, and the second leg up excuse me, to higher prices begins to surface. That certainly is a possible scenario as well, and it might be one that sucks in the aggressive shorts here with that expansion, that small immediate expansion in volatility, and then when everybody's back on the short side and sold off their longs because they think the retest is coming of the lows, the selling stops here, the market stabilizes, and then off it goes to the upside. Again, it's all three different scenarios. Of course, anybody, making a strong claim at any one of those three things happening is, really just kind of fooling themselves to know, with any, certainty how it's going to actually unfold. So we'll take it one day at a time. We'll measure the short-term levels like we have right now, and we'll measure how the market reacts and how the trading actually develops throughout the day-to-day basis. And I think that's of course, the best thing we have right now for us. So all in all, I think that covers the major markets here. We still have, extreme risks. We're still in a high volatility environment. We are getting some more signs of stabilization, but we do need to, still focus on risk management, of course, first and foremost, and start to pay attention to some of those near-term levels for a potential rollover, excuse me, and change of character. So if we get into some of the other majors now, we look at Russell 2000. So if we look at the Russell 2000 here, again, this was hit the hardest. It did rebound up, and it is still holding above this range here. So for now, it is still continuing in its constructive action. I think as long as it's above 110, then we at least have the benefit of the doubt to the buyers here in the very short term. But if it starts breaking below this cluster of 3 and 4 day lows, and if it starts falling back in this range here around 110, I think you have to be careful. I think that's where the risk starts to open up again, and then we would have to see if it's a higher low scenario or if it's a fallback into this range. But all in all, I think the Russell 2000 still pretty much sitting there quiet and waiting to see which way this pendulum swings. And the NASDAQ 100 did try and get going today. It tried to move and break out, but you can see the big tail up here near highs got rejected. It closed back into Friday's range, and once again here, I think this 183.50, this is the equivalent zone here for the Qs. As long as it's holding above 183.50, I think you can give it the benefit of the doubt here. If it starts breaking below 183.50, I think that's your risk in the sand, line in the sand to start to potentially play some defense and think about volatility sort of coming back. So that is the market environment in a nutshell. It actually, even though the VIX is still where it is and ranges are still wide, it almost seems, pretty calm and collected here, especially given what we went through most of March. So it's amazing, again, how expectations just get, just changed so quickly here when we're dealing with such extreme ranges. Now, if we go to TLT here, you can see starting to lose this level. So we talked about this 166 level. It started to break above it on Friday, got a little bit more of a rejection and some resistance coming in yesterday on Monday, and now we're getting follow through to the downside here. So TLT, again, still holding in its uptrend. Would not be surprised to see just a sideways cool off type of action here. It's well deserved, much needed in my opinion, just given all of the craziness here that has unfolded throughout the month of March. I think just seeing a compression in range and letting this market collect itself would be very healthy, frankly, and something that would be welcomed probably by both sellers and buyers, frankly, in TLT. So that's where bonds ended out the quarter. If we go to gold next, you can see gold selling off today 3.18%. We thought it had a chance to get back up here and retest this 158 when it was trading over here. That did not happen. We in fact got the rollover going for that gap fill down here and into the middle of this range. Again, this has had a very large trading range recently, so seeing some cool off action here I think would be healthy. Right now gold spiraling to the downside. Maybe if it can find some support around 146, put in a higher low, that could be constructive in the coming weeks. Silver also rolling over a bit here. Volumes dried up a bit, but it had that aggressive sell-off 2 weeks ago, down 15%. Last week it rallied 15%, and now it's starting to cool off. So again, huge ranges here on a historical basis for commodities, and starting to see some of that compress a little bit, I think makes a whole lot of sense. Now, if we look at USO, this is one where we're still seeing ranges expand. We're still seeing momentum to the downside. USO is continuing to kind of steamroll lower. There are some, maybe some small signs of exhaustion here. There's some positive momentum divergence. We're getting a little bit of a hammer action yesterday on Monday, but this is still in a very steep and broken downtrend here, so you have to be careful in oil holding this overnight and trading it. There's tremendous volatility. This move is big on just a several day basis. I mean, even getting back up to levels seen 4 days ago, you're talking about a 20-25% rally here in USO. So remember, the ranges and volatility are quite wide here. So just keep that in mind if you're trading. Of course, if you're a short-term trader, day trader, then you got some, you got nice moves, fluid moves to work with during the trading session. Last but not least is natural gas. Pretty much continues to move sideways here. Hasn't really broken down. Again, we've talked about the fact that this has been sort of ignoring the volatility storm for the most part. It is still in a downtrend. It is still, has much to be proven here to, any of the bulls or any of the long trades. But I do think now that we have another couple of weeks behind us here trading, I think this 1320 now becomes, again, just a good level to pay attention to. If we get above 1320, maybe that ignites a move to the upside, but we can overall see volume has dried up here as it trades near those lows. So that's it. That's, I think, covers all of the action this week so far. Again, just watch, be mindful of your risk, watch the risk overnight, and know your time frame. I think those are two very important key lessons we'll continue to hammer home, because I think now more than ever, that really matters here. And going into tomorrow now, we can start to measure how the S&P 500 handles this prior 4-day tight range that it's developed in since Wednesday, or Thursday. So that's it for me. Thanks as always for tuning in and watching. You can subscribe on our YouTube channel or follow us at The Trade Risk. Have a great rest of your day. We'll see you back here tomorrow for some swing trade ideas during the session.